Welcome to the deep dive. Today, we're getting into three big players in U.S. finance: the SEC, FDIC, and the CFPB.
That's right.
It can get confusing, so we're going to try and break down who does what, kind of a roadmap to financial regulation.
Exactly. They each have really distinct jobs, even though they all operate in finance.
Hmm.
Clarifying that is key.
Okay, let's jump right in then. The SEC, Securities and Exchange Commission. What's the main idea there?
Securities markets. Simple as that, really. Their core mission revolves around protecting investors.
Protecting investors.
Yeah, and maintaining fair, orderly, and efficient markets. Plus, helping companies raise the capital they need to grow.
So keeping the stock market game, let's say, fair.
That's a good way to put it. They oversee the major players.
Like who specifically?
Well, you've got your publicly traded companies, of course, the ones listed on exchanges.
Okay.
Then the exchanges themselves, like the NYSE or NASDAQ.
Yeah.
Also brokers, dealers, investment advisors. Essentially the infrastructure and participants of the securities markets.
Right. So how does that actually, protect someone like me, the average investor? What's the practical effect?
Transparency is huge. Think about it. Before you invest in a company, you need solid information, right?
Definitely.
So the SEC mandates that public companies disclose significant financial information. Their earnings, debts, risks, all that stuff.
So you're not flying blind.
Precisely. It allows
Yeah.
you to make informed decisions. It's about leveling the playing field through information.
Makes sense. Okay, let's shift over to the FDIC, Federal Deposit Insurance Corporation. Different focus.
Totally different focus. Think banks and your deposits. Their main job is maintaining stability and public confidence in the nation's financial system.
And they do that primarily through deposit insurance, that sticker you see at the bank.
Exactly. That FDIC logo means your deposits are insured up to a certain limit, currently $250,000 per depositor per insured bank for each account ownership category.
That's a pretty significant safety net.
It's crucial. It prevents bank runs. If people worry a bank might fail, they know their insured money is safe, so they don't all rush to pull it out at once, which could actually cause a failure.
So what if the worst happens? A bank does fail. How does the FDIC jump in?
They act very quickly. Often they'll facilitate a merger, finding a healthy bank to acquire the failed one and take over its accounts. So for depositors, it's seamless.
And if they can't find a buyer?
Then the FDIC pays depositors their insured money directly, usually within a few business days. The goal is always to protect depositors and minimize disruption.
Okay, that's clear. Bank stability, deposit protection. Now, the third one, CFPB, Consumer Financial Protection Bureau. What's their world?
Consumers. It's right there in the name. They focus on protecting consumers in the financial sector. Think everyday financial products.
Like what kind of products?
Mortgages, credit cards, student loans, auto loans, payday loans, debt collection, basically the financial services and products ordinary people use.
And what are they protecting consumers from?
Unfair, deceptive, or abusive acts or practices. They write rules, supervise companies, and enforce the law to make sure financial institutions treat you fairly.
Okay.
They also play a big role in financial education, helping people understand the fine print and make better financial decisions.
Can you give a quick example? Like, how would I feel their impact?
Well, remember the clearer mortgage disclosure forms that came out a few years ago, the know before you owe rules.
Uh-huh.
That was the CFPB, making it easier to understand the terms and costs of a mortgage before you sign on the dotted line.
Yeah.
Or rules about how debt collectors can contact you. That's their domain.
Got it. So, three agencies, three distinct roles. SEC, Securities Markets and Investors. FDIC, Bank Stability and Deposits. CFPB, Consumer Protection in Financial Products.
Exactly. They operate in the same broad financial universe, but their mandates, the entities they regulate, and the people they primarily protect are quite different. It's not really overlapping as much as complementary.
Right. Different pieces of the puzzle. Okay, quick summary then. One sentence for each. SEC.
SEC regulates securities markets to protect investors and ensure market integrity.
FDIC.
FDIC ensures bank deposits and resolves failed banks to maintain financial stability.
And CFPB.
CFPB protects consumers by enforcing rules for financial products and cracking down on unfair practices.
Perfect. So hopefully understanding these roles helps you, our listener, feel a bit more confident navigating the financial world, knowing who's watching what.
Definitely. And maybe it sparks some thought. For instance, how do these agencies coordinate? Or where might there be gaps or potential conflicts in their jurisdiction? Something to consider.
A good thought to leave on. Thanks for breaking that down.
My pleasure.